Thank you, Jason. Sean McCann, if you don't mind, I'll bring you on here. And while Sean's kind of coming on, I think the feedback we got from the audience in last year's webinar was, hey, we really liked hearing from your roster of advisors. And, I honestly didn't know you had that many advisors. And, I enjoyed listening and hearing their perspectives. So we've tried to bring on a mix of advisors here. So Sean, Jason and I talked about it, right? Interest rates have moved, and they've moved substantially. I'm going to pick on the 2-year, right? The very liquid side of the curve. You've gone from, again, back to my simple analogy, the U.S. government or U.S. Treasury, give it to them for 2 years. They pay me 0.7% for 2 years. Give me my money back. That number is approaching 4% right now on the 2-year. So as somebody in our investment research team, when interest rates on the short end of the yield curve move that substantially, what are the implications, right? I think I'll give you a lead in. You're rewarding savers, right? I mean, like if you're clipping coupons, you're clipping them at closer to 4 instead of 0.7, and that should feel a lot better, although inflation keeps running hot. Any perspective on that?
Yeah, I mean, I think when people hear interest rates, you hear the term interest rates, they think of two things, fixed income / bonds, or they think of their own personal debt. And on that fixed income side, a lot of investors own that for capital preservation and income. And, as you and Jason already mentioned, although rates have negatively impacted the returns for fixed income this year, with the ag being down about 2.5% year to date. When we look at
12.
valuation of fixed income,
yeah, the ag being off 12, not 2.5. But you're fine. Sorry, go ahead.
12. Sorry, I meant 12.5.
Yeah.
But when we look at the valuation of fixed income relatively compared to the last few years, fixed income as an asset class is much more compelling now since rates have risen from their COVID lows. And then on the income side, kind of as you just mentioned, savers are starting to get rewarded for investing in fixed income. And as you mentioned, the yield in the 2-year trading at, I think it's actually at 4.1 now today, which is over 5 times higher than where it was at the beginning of the year, which is quite crazy to think about. But, and that's obviously due in part to raising rates from the Fed. But if we look at taxable money markets, for example, they yield now between 2 and 2.5%, which, in our opinion, serves to be a much higher yielding space to park some extra cash, for example, than savings accounts. And then, if we look at fixed income on an asset allocation basis, risk-free rates at around 3.75, depending on where you sit on the yield curve, and higher yielding corporate bonds, they yield between 4.25 and 4.75. It's not a bad place to be in a volatile investment environment. And then, the other area I'd like to hit on is, if we look at investment grade municipal bonds as well, they currently yield around 3.5% with the taxable equivalent yield, that for those maybe in the highest tax bracket, it's around 6%. So, this yield is at its highest level that we've observed for, this investment grade index for over the past 10 years. So, overall, yields are up, and fixed income, generally speaking, is not really a bad place for investors to thinking about parking some extra cash at the moment.
Good stuff, Sean. We appreciate the perspective. I'm going to keep this moving along to try and clip this 11 o'clock. So I'm going to have Matt Biggs join us now. So Matt, I think, we haven't referenced it specifically, but the 30-year mortgage interest rate, if we play off of what Sean and I talked about, right? Rates have moved substantially. 30-year mortgages just went north of 6% for the first time in 14, 15 years. And I think the question we would have, and maybe it's geared towards the younger investor, simply, Matt, does it make sense to buy a house when your 30-year mortgage is at 6?
Yeah, no, I think that's a question a lot of people are probably asking themselves today if they find themselves in the housing market. And I can tend to be a little long-winded, similar to Jason, so I'm going to try to do my best Dave impression and keep this short and sweet. But there is a reason, full disclosure, that I'm the one answering this question, right? So I actually, my wife and I, we bought a house within the last 30 to 40 days. So I'll use that as a slight example kind of going throughout. But maybe to get at some of the data behind it, Dave, it's rates certainly feel expensive right now, right? You know, the 30-year just a little bit over 6. Last week, that was the highest it had been in over a decade. So I think there is some recency bias, though, right? We feel like it's high. If we kind of zoom that lens out 50 plus years, and Jason said it earlier, he had his parents, I think was the example he used, had a rate at 16%. And I'm sure there are multiple people on this, on this webinar that know of an example of, 10+% interest rates. So historically, over that 50-year time frame, the average has actually been 7.75, somewhere around there. So if we're looking today, 6, on a relative basis, kind of over the last 50 years, that's still pretty in line and cheap compared to 7.75, the historical average. So I think, there are a couple things you have to keep in mind. If you're wanting to buy or in the market and you feel like that rate is too high for you, well, what are your alternatives? So you stay where you're at, you rent, or you kind of bite the bullet and you buy at the 6% right now. So in my example specifically, we looked at renting just because we needed bigger space. I've got a growing family. We needed more room. When you did the math at current mortgage rates on a 30-year mortgage versus renting for a house that you need, it was the same monthly cost. So in my situation, it made sense. I felt like, if I'm going to buy, it makes sense. Everyone's going to be unique though. And I think those are the conversations we welcome. So maybe just a couple more points on some of the reasons.
Why don't you go to the long-term benefits that we historically have seen when you tie personal finances to homeowners? Yeah.
So long-term, and if we take that 50-year scope and zoom out even further, the billionaire Andrew Carnegie famously said once that 90% of millionaires got their wealth by investing in real estate, or that was kind of a piece of their overall net worth. If that holds true today, I'm not sure, but I think there are some merits to it. So, number one, you think the forced savings and the paying down debt on a long-term asset that should be appreciating. So if you look at, average housing sales over that same exact time frame, you kind of just see up and to the right the whole time with a couple blips here and there. So not just, paying down the debt, adding to that equity value, but you're also forcing yourself to do that every month.
Yep.
The devil's advocate view would be, okay, well, you own a home. Now, what else comes with that? I'll, again, use myself as an example. Tuesday, our AC goes out, and I'm thinking to myself, wow, is this going to be $5 to $10 within a week of living here? Luckily, it was just the air filter, but these are the things you have to kind of be able to deal with. Third thing is, with that, you can get what's called a HELOC or a home equity line, so that kind of frees up the cash, and that's just a separate way for you to tap into some equity and some cash, and you've got it available if an attractive investment or you need a new AC comes along. And then the last point I'll make is, look, a lot has changed since COVID. I think we can all acknowledge that, and especially people's views on their homes. So home is basically your house and a quasi-office at times, and people are spending more and more time at their houses than they ever have. So I guess to summarize and answer the question, everyone's going to be unique, but I still think in most situations, it's going to make sense to purchase, depending on your circumstances.
Good stuff. Thank you, Matt. Greg, we've got 2 more questions. We got Greg and Derek here. So this is just going to be an obvious statement. Hey, Greg, it's been a super volatile year. I, the individual investor, am struggling. I know the stats. I know long-term is the way I should be investing, but I'm struggling. What do I do?
Yeah, it's a great question, Dave. And I think, if you kind of take a big step back and look at it, it's really a process. And I think each of the steps is kind of equally important. First of all, you really kind of want to consider your own experience and feelings about risk. I think at this point, most people have had some sort of market-based investment at some point in their life or some exposure to it. So I think a real kind of hard, honest look at yourself and a genuine assessment of what's acceptable and what causes excess stress is really kind of, just a very beginning point overall. if even modest market fluctuations make you nervous, you're probably not the type of person that needs to be invested in a very aggressive portfolio, because I don't think it's something you're going to be comfortable sticking with in the long term. And really, we've talked a lot about market data. You and Jason went over quite a bit of data, much of it very good, actually all of it very good. But there's some really good data points out there that will kind of educate you on what risk really looks like and what different types of investing really look like. And I think that's part of it too, saying, hey, what do we mean by risk, right? What does this really look like? If I'm moderate, what does that mean? If I'm conservative, what does that mean? If I'm aggressive, what does that mean? I think that's a huge part of it, is to understand, what are we talking about when we define things as moderate, aggressive, or conservative? I think understanding what risk really is the most important. The assessment really isn't so much about the upside, which is where I think people kind of lose focus in really good markets, right? They see plus signs on the statements. They think this is normal. They get to a point where they see consistent negative signs. They feel like maybe this is not normal. But going into it, understanding what the negative signs might look like, I think is probably more important in the assessment than understanding the positive. And then I think too, a super important part, and this is where a lot of really good perspective comes into play for clients over time, is defining what your short and long-term goals really are, right? So if you're talking about, a pool of funds, perhaps, you've got a 5 or 6 or 7 year plan. Hey, at a certain point, I want to save up enough money and I want to buy a house. That pool of money that you're working on to do that is going to look very different in investment terms than I'm 35 years old and I've got a 401k and I'm going to work till I'm in my late 60s or 70 because that's what I want to do. Those are two extremely different pools of money, and they will have and should have very, very, very different risk profiles. So understanding A, what does risk look like, and B, what do these long and short-term goals sort of define in terms of what your risk profile ought to look like, I think is absolutely huge. So having a plan and goals and a focus on the longer term, I think creates a lot of perspective on that once you understand what risk really looks like. And I think equally important also, to kind of keep the process working, you need, kind of a disciplined approach to what your portfolio composition looks like. It's not good enough to just say, hey, well, I've defined myself as moderate and I've defined the right pool of money for my moderate investment strategy. I'm going to set it and forget it. It's not how the world works. You see, we've looked at all this data today about how much fluctuation there is in the market. The market's proven time and time again that it's a very volatile, cyclical animal. We know this. We can all agree on that. That's going to impact your portfolio. One of the things that you see a lot is when you've got a long, good run in the market, right? A bull market condition, a couple years of positive returns. If you don't make any changes to your portfolio, maybe you started with a 60% equity model, 40% fixed income. After a bull run, you might be 80% equity or 85% equity. That has a very different risk profile than your original 60-40 model does. So if you don't put the work into understanding the goals for the money and doing some systematic and periodic rebalancing with those investment funds, you're going to find yourself sometimes unwittingly in a very different risk profile than you started with.
Good stuff. All good perspective, and apologize for the audience. We're trying to be sensitive here, but obviously, Greg, we could go deeper with clients that might be struggling in the current environment. Last but not least, I'm going to have Derek Eichelberger join us, and then a couple of housekeeping items, and we'll wrap up today's conversation with you. So, Derek, I in the prep, I mentioned that you've got a great example that I think ties a lot of concepts that we're talking about in today's webinar. In that, hypothetically, I'm going to play off of what Greg just gave me, and I've sized up. I'm not comfortable in today's environment. I'm off 15, 20%. I was super comfortable being up 25, 30, but now I'm not comfortable. You know what, Derek? I think I'm going to go to cash. And I'd like you to explore that psychologically and from an investment perspective for the audience, maybe to kind of put a close on today's conversation.
Oh, sure. And I've been through a lot of different environments where the stock market went down significantly in my career. And, it kind of comes from that same place when people are down, they want to do something and they think that's in their best interest. So, that strategy only works if you sell out at a certain price and then you're able to buy in at a lower price, right? It's simple. And so why doesn't that work for people? And this gets back to a lot of what, Mike talked about at the beginning of, how we're wired as human beings. When you're selling out in the current environment, the market's forward looking, it's looking at what's going on, it's predicting, and it's pricing things, knowing, what we know today. So then, in order to buy at lower prices, we need the stock market to go down further. So what would that scenario look like? It would look like worse news. It would look like worse articles that are being out there, and then it'd be worse conversations on CNBC. So to have someone that is selling out of a market because they're worried, and then have the fortitude to buy in when the storyline's even worse, is just not something that people do. And I've seen that over and over throughout my career. Let alone thinking about the impact that you'd have of a tax bill that might go along with that, with a lot of embedded gains. So it's not something that we're wired to do. So it's better to, have, as Greg was saying, take a long-term perspective. If you've been doing things like rebalancing, you've been taking risk off the table at those times. But we all want to, be in the market when it's going up and not be in the market when it's going down. But if you're a long-term investor, you're inevitably going to have these time periods. And, it is actually better to do the reverse of what you think. And that is to start systematically, whether it's dollar cost averaging or doing some rebalancing, start to buy the things that are now cheap. And it's just, it gets back to all this behavioral talk that we're discussing, which is, people don't have bad outcomes because they haven't, found that next Bitcoin or that next, stock that's going to, it's because of how they react to different market environments and the decisions that they make. The behavioral things are the biggest issues for long-term success.
And maybe in closing, I'll add on maybe to yours and Greg's piece. Look, selfishly, we are financial advisors. So this is not a plug for Schneider Downs Wealth Management. It's maybe a plug for just a valued advisor, period. An advisor can help you with a lot of what Greg and Derek just talked about. We're fortunate enough to work with really successful people that are really intelligent, and they still want us riding shotgun. Either, hey, look, I don't have the time to do it. You're a third-party advisor. You're unlikely to get emotional because this isn't your money, and you're going to think more rationally and just kind of shoot me straight when I'm getting off the rails. So, in closing, that's more or less the plug for you, the individual investor, to consider working with an advisor. Obviously, we'd love to have a conversation with you, but I'm really more or less making a plug for having a trusted advisor. Really does help you with the long-term success and mitigate some of those personal biases and things that we talked about.